inexorable problems of personal finance, and that's what we turn to now. Feroze Azeez is our expert. He's from Anand, Rathi Private Wealth Management, and he joins us. Hi, Feroze. Well, the question today is multi-asset funds. They might have been working wonders given the way gold, etc., had been rallying. But now with the commodities as a basket coming under pressure and equities not really performing, do they still hold relevance? Give us an idea. I mean, you need to explain to us how multi-asset funds function in terms of percentage asset allocation and their relevance going forward.
Right. As of now, these multi-asset funds are actually funds which distribute assets across different asset classes. Right? When things are very difficult for an investor to choose, these kind of funds actually in uncertain times become more relevant. For the fact that they decide, the fund manager, you leave the allocation to the expert. There are two prominent kind of asset class oriented funds, the multi-asset funds. One of them which mix gold, equity and debt. The gold, equity and debt funds, basically if they are dynamically managed, the gold portion and the equity portion predominantly have a significant hedge over each other. So they bring down the risks considerably, still retaining the expected return high. And these funds actually, from an SIP perspective, for a retail investor, make perfect sense for the fact that the rupee cost averaging gets amplified. So basically, these work as three different assets put into one fund. So it leaves the fund manager's discretion on the allocation, which seems very, very profitable in these uncertain times. So that's sure. One point. The SIP mode amplifies the rupee cost averaging significantly because there is significant portion in the debt. Due to high interest rates, the accruals of those high interest rates actually take care of the capital preservation over long-term periods. So one of those is the gold-linked MIPs or assets, multi-assets. There's one more very interesting category which has emerged over the last year and a half in the asset management space, which is called the dual advantage funds. These dual advantage funds mix debt and call options, which are very, very interesting for the fact that a retail investor gets maximum exposure to equity, still preserving his capital over 3-year periods. So that's one thing which has gained flavor, and about 50-55 NFOs which have come over the last year and a half.
Feroze, hi, afternoon.
Hi.
50-55 NFOs last year, but any fund which has a longer track record than that, and has any of them actually outperformed, say, even a fixed deposit?
Yes. So these dual advantage funds actually are closed-ended in nature, right? So the fund manager buys debt and he buys a call option. So here there's not too much of a human intervention. It basically becomes an index fund almost with a capital protection, which is a significant improvisation on any other index fund for that matter. So there's no human intervention. To answer your question whether any of these have matured, no, none in fact, but there is no human intervention. You are dependent on Nifty, and if Nifty performs very well over the next 3 years, looking at the current valuations, which seems likely if we are able to sail through these uncertain times, then the client still has his protection on the capital, which should keep him less worried.
All right, let's take a break on that. We have some viewers with questions. We'll come back in a minute.
We've been discussing personal finance with Feroze Azeez. It's time to introduce a caller now. Vikas Bij from Gurgaon now joins in. Vikas, hi, afternoon. What's your query?
Hi, afternoon. Yeah, I've been watching this gold sliding in the last 4 days, and I've been tuning into the channel to see what is the outlook from your strategist. So what is being discussed is jewelry companies and how gold is impacting banks and so on. So I was trying to find out answers on gold ETF. I've been investing in gold ETF since 2008, and it's been a good going all the while. And suddenly in the last 3 days, everything is tumbled. So I wanted to find out what is the outlook on the ETF, because this has been accumulating over a period of time, and suddenly you see complete loss of all your profits shared away.
Yeah, indeed. In fact, if you look at say something like a Goldman Sachs B's, that's also ETF, that's also fallen quite a bit to 2,400 from 2,900 just a few days back. Feroze, the call here is that ETFs at the end of the day do tend to underperform the physical gold a bit, especially in scenarios like this. What's the call for Vikas now? Should he stay put with this ETF, maybe invest more? Should he go for physical gold? What's the call for Vikas and for millions others who are watching and want to know the advice on this one?
Super. ETFs generally tend to replicate gold, okay, but in times of exaggeration in terms of movements, they tend to digress from the underlying. Okay, it's from an investor's perspective, it is never advisable to have substantial portions in one asset. Okay, that's a thumb rule kind of a recommendation. Now, switching our focus on the prime question of what should somebody do if he holds substantial portion of his assets in gold is going to be under pressure for the fact that it has rallied, and it has rallied and broken resistances on the downside. There are 3-4 reasons why there will be pressure on gold going forward as well. So I could probably touch upon those reasons. Basically, like Cyprus in the Eurozone, when there is stress, instead of austerity, they would be focusing on reducing their gold reserves to provide for stimulus. And there has been the largest gold fund, or the ETF of the world, has been at the lowest assets today. So there is enough signs that gold will remain under pressure, having broken the lower resistances and the macroeconomic indicators suggesting that gold will be under pressure. So for Mr. Vikas, I think it's very critical that you divest substantial portion of your monies out of the ETF and leave a portion which can be not more than 20% of your portfolio, and look at debt for 50% of the money and 30% into equity would be my first reaction. So on the debt side, you have high interest rates which you will enjoy for a little while. So it's very wise to capitalize on the debt rate and provide the returns, provide for the growth assets accumulation. So you can look at 30% of your equity going into a weekly STP kind of a mode, into an SBI emerging business fund and an ICICI focused blue chip fund, which should give you a diverse equity portfolio, and your debt accruals are going to be high, and it'll also give you some capital appreciation if interest rates soften, which they're expected to, looking at the indicators. So,
all right, Feroze, thanks a lot for that advice, because well, that's the reality. All asset classes are likely to take away what they have given, or at least part of it. So the important thing is not to put too much in any of the asset classes. If it is more than 20%, as Azeez suggests, maybe it is time to cash out and take what is left of the profit. That's it on this edition of Personal Finance, but do remember to join us at the same time tomorrow. Our expert will be Harshvardhan Rungta, and he will tell you how to maximize your current gold investments given the way the prices have slipped.